Late cycle typically means global growth has been strong for a number of years. Typically equity markets have run hard and valuations are probably stretched like they are now. The return to equities this year has been quite extraordinary after the sell-off in Q4 last year. Forward indicators of economic data are starting to turn down. One economic data point we look at in particular is the PMIs, manufacturing PMIs. They've been turning down. So China has a PMI below 50 now, indicating contraction in its manufacturing sector. And a number of indicators from the bond market, a flat yield curve where the yield on long-term bonds is basically equivalent to the yield on short-term bonds. So the bond market, which is typically better than the share market at picking recession, is saying we're getting close to the need for rate cuts and they're factoring in rate cuts in the future. That would typically indicate we're getting towards the peak. The starting point should always be your overall framework for managing risk. And what we mean by that is the long-term asset allocation that you as an investor have decided on that gives you that good mix or the appropriate mix of risk and return. It produces a volatility that you can cope with, that you can expect, because you don't want to sell just at the wrong time. If you get that right, that strategic long-term asset allocation, markets will sell off, you'll be expecting that, it'll be within your expectations and you won't sell just at the wrong time. So that's the starting point. But there are some simple strategies an investor can do. Reducing shares, obviously, very easy to do. But rather than keep it in cash, buy bonds, because typically in a downturn, bonds will increase in value as shares decrease. Within bonds, because yields in developed markets and Australia are particularly low, have a look at emerging market yields. Yields are higher there, but be careful. Have a look at the credits that you're taking on, the manager, what's their track record? Is there protection on the downside? Can you create, are there vehicles that give you that protection that are inherent in the fund? These are some of the things that we have available that we have been proposing to our clients. And the final thing, look within your portfolio. Look at the defensiveness of the sectors or the equities that you're exposed to. We talked about the domestic economy. We're telling our clients to bias the portfolio away from domestic sectors like retail, banks, building materials. The flip side to that is to have more exposure to foreign earners. Healthcare, miners. The miners have the advantage of some terrific cash flows, and that's reflected in some really good dividends. And finally, certain infrastructure stocks and listed real estate trusts in Australia in the office and industrial markets.